Welcome to Compound Growth. In this video, we'll look at 5 ways that people try to build their wealth and the likely results of each of those, how compound growth works, understanding risk and opportunity, how the forex market works, and how you can get to done-for-you wealth. Let's get started. The ways that people try to get wealthy: the first one is to invest every month for decades. The second is to start your own business. Third is playing the stock market. Fourth is starting a side hustle on the internet. And the fifth is trading forex. We'll look at how each of these pans out for most people, and we'll understand the principles behind what makes them successful or not so. If you invest every month for decades, then in the end you get great results. It takes a huge amount of discipline. Many people never manage that, and therefore they never get the result. But if you're able to put aside, let's say, £100 a month, and you start when you're young and you keep going through your working life, by the time you retire you'll have a sizable fortune. Great results from decades of discipline. Starting your own business is tough. I've done it several times. The statistics show that in the UK most of businesses that start off will fail within 5 years, and of those that are still in business, 85% of the owners never get rich. There are about 5% that do really well, that's 1 in 20, and there's probably a couple of others that do reasonably well. The majority of small business owners have a job that keeps them working long hours. They may love it, they may hate it, but it never makes them wealthy. The next option is to play the stock market. The sad fact is that most professional stock traders never beat the market. In other words, they never get a better return than the average off the stock market as a whole. Amateurs tend to do much less well than that. So it's a high-risk way of putting your money to work, trying to make it grow. You could make a lot of money, or you could lose a lot of money. Side hustles on the internet. The internet is full of people who have made their millions and are prepared to tell you for a large sum how you can do the same. Starting a business on the internet takes effort, time, flexibility, in some cases a lot of money, in other cases not much, but a lot of resilience, because most of what you try in the first few weeks is not going to work. So it's a matter of having that resilience to bounce back again and again, try something different, keep doing different things until you find something that works. If it works, if you've got the flexibility and the resilience to keep going for those initial weeks, you might be able to make a success of it. Many people start off and within a couple of months they've given up because it didn't work out for them. Let's look at trading forex, or foreign exchange. The foreign exchange market is the biggest business on the planet. It turns over $6.5 trillion a day in trades. Now, most people that set out to do it for themselves, to learn to trade and make money on forex, will fail. It's a difficult market. It requires years of experience to get consistently good results, and most people run out of money long before they get there. There is another option, which is to have it done for you. You can find an experienced trader or a hedge fund that will take your money. They will do the trading for you on the forex market, and that's a very easy way to wealth. We'll come back and think about that later. So how do you grow your wealth? The principles are: you need to understand money, time and growth rates, and risk and opportunity. And you need to understand them better than most people, because most people understand them in a way that keeps them from being wealthy all their life. Starting off with money. You might think that money's obvious. If you've got lots of money, you don't need to worry about it. But most of us that want to become wealthy are starting relatively skint. We don't have much that we can put into investments, and therefore we need to really focus on the other 2 items, the time and growth rate and the risk and opportunity, in order to get out from where we are at the moment and join the ranks of the wealthy. Time and growth rate is really important. Most people don't understand compound growth. They understand linear growth. Here's an example. If you have an Olympic swimming pool that's going to be just over 2.5 meters deep when it's full, and you fill it up by putting a big hose into it that's pouring out the same amount of water every hour, then over 10 hours you can fill the pool from bottom to top, putting in 1/4 meter of water into the pool every hour, and after 10 hours there you are. That's the kind of growth that most of us understand. It's the same thing as watching a tree grow. If it grows 2 feet every year, in 10 years it'll be 20 feet taller, in 20 years it'll be 40 feet taller. It's straightforward. That's not how compound growth works, and compound growth is the secret to growing wealth. Albert Einstein is said to have said that compound interest, which is also another word for compound growth or exponential growth, is the eighth wonder of the world. Those who understand it earn it, and those who don't pay for it. And this is very true. People who don't understand interest and compound growth borrow money that they can't afford. Then, as well as having a debt, they're paying interest on the money they've borrowed, and because they can't pay off the whole amount, they end up paying interest on the interest on what they've borrowed, and the debt gets bigger over time and goes down into a spiral. The wealthy, on the other hand, invest money, they earn interest on it, and the next year they earn interest on the interest, and the year after that interest on all of that interest, and so they're getting wealthier and wealthier as time goes by. Let's look at some examples. If you were to use compound interest or compound growth to fill up that swimming pool, you could start with just 1/4 of a centimetre, and then if you doubled it every hour, it would go to 1/2 a centimetre, 1, 2, 4, 8, 16 centimetres over the first 6 hours. In other words, the pool would still appear to be virtually empty, be barely over your ankles after 6 hours of filling it up. But in the 7th hour that doubles to 30 centimetres, then it goes over 60, over 1.25 meters, and on the 10th hour, pool is full. This is the way that compound growth works. It may be a steady rate of increase, but the amount that happens gets dramatically larger as the periods of time go by. Let's say that you could save £100 a month, and you decide that every year you're going to increase that rate by 5% to cope with inflation, but you're not earning any interest on it. Over 30 years, you would put aside £79,726. So that's a fair amount of saving. It's taken you a very long time to get there. If you could earn interest on that money at 8%, which is the average rate of return on the stock market in the UK, and you're still putting in your £100 a month, increased every year by a 5% amount, instead of making nearly 80,000, you'd have made nearly £250,000 over 30 years. So that 8% interest really kicks in, particularly in the later years, when you're earning interest on interest on interest from the earlier years, and it grows your pot faster and faster. If you could get a better rate of interest, let's say you could get 12%, then that same rate of saving and investing would end you up with more than £500,000. And if you could take it up to 16%, you'd be over £1 million in 30 years. So the difference between having no interest at all and having compound interest at different rates is really significant. And the higher the rate, then the faster you grow your wealth. Let's take another example where there's going to be no annual increase. If you put in £100 a month over 30 years and there's no earned interest on it, you get 36,000 in savings. So if you just put that £100 under the mattress every month, after 30 years you'd have £36,000 under your mattress. If you could be earning 16% annually on it, then that same amount of saving would get you to nearly £900,000 after 30 years. If you could push that up to 25%, then instead of £800,000, you'd have £8 million and change. So you can see that the interest rate makes a massive difference, even if you're not increasing your contributions. These are the sorts of rates, 0, 16%, 8%, exceptionally 25%, the sort of rates that you get from stock investments. The forex market goes much higher than that. There are traders on the forex market making anything from 10% to 50% profit per month rather than per year. Let's look at how that works. If you could put £500 into an account and it was earning at 20% per month, that 20% per month accumulates to nearly 800% per year. So what you get out at the end of the year is much more than you put in at the beginning. So that £500 after 1 year of growth at this rate would be nearly £4,500. After 2 years, it would be nearly £40,000, and after 3 years, it would be over £350,000, which is enough to buy a substantial house, or if you took the income that's coming from that at that stage, you'd be rich for life. So getting these rates of interest is massive. Let's look at that in a graph. Here's how your £500 would grow if you could get that 20% per month. It would go from £1,000 in year 1. The end of year 1 you're over 4,000, 40,000, 350,000. You can see how it massively increases in value over that 3rd year. Let's say that you could keep it going for 4 years. That would take you into the millions. You'd have over 3 million at the end of 4 years, assuming you'd taken nothing out up to then. And if you keep going for 5 years, you're into 8 figures, nearly 30 million in assets, just from a £500 starting point because of the massive growth rate. What's that got to do with you and your possibilities? Well, let's look at the 5-year graph here, and you see that that 4th year and 5th year massively outshine the earlier years. So this is without doing any work. This is just having an investment that's growing very fast, and it could make you wealthy within a few years. That 28 million is more than most people earn in their entire lifetime, and you could get there in 5 years. So what about risk and opportunity? These are the things that put most people off from getting wealthy. They misunderstand risk and they misunderstand opportunities. Risk has got two sides. There's an upside of what could go right and a downside of what could go wrong. Back in caveman times, the what could go right might have meant that you got a nice meal. Okay, let's climb the tree and pick some apples. The what could go wrong could mean instant death. If you don't get out of the way of that tiger, he's going to be eating you for supper, and that's the end of your life. Our ancestors were rewarded for avoiding danger far more than they were rewarded for finding good things. And that's the way that our brains are wired. It means if you want to look at a risk sensibly, look at the upside and the downside, you need to think firstly, how likely is the upside or the downside? In other words, what's the probability of getting the good result rather than the bad result? And how serious would that be if you got the good result or the bad result? This is the way that your brain works. Your brain looks at what could go right a little bit and what could go wrong massively. And that makes most of us what is known as risk-averse. So the way that most people see risk is the possibility of things going right is small, the possibility of things going wrong is huge in their mind, and that puts them off the opportunity. If you could rebalance that so that you could change the probability of things going right, so it's much bigger than the probability of things going wrong, so you've got a big reward and an unlikely danger, and if you could reduce the likelihood of the danger, in other words, make it smaller and smaller, less and less likely to happen, and you could reduce the severity of it, make it not serious, so if it did happen, it really isn't a problem. Turn the tiger into pussycat as an example. Then you could have a much more balanced view of a risk. One of the things that forex traders use is leverage, and this increases the risk in a way that allows these massive returns to happen. Leverage means that if you're trading at a 1 to 500 ratio, which is quite common, and you invest £1 in buying US dollars, then you'd actually be trading with £500 worth of US dollars rather than £1 worth. That's what leverage means. Now what that means is that if you bought some dollars with your pound and the US dollar increase in value by 1 cent, then rather than buying $1.30 and it going up to $1.30.7 or something, you're buying £500 worth of dollars and you'd make a $5 profit. Similarly, if the dollar went against you, it lost 1 cent in value, you'd make a $5 loss. So you're making 500 times bigger profit or loss with each trade than you would if you were trading not using leverage. So how can you mitigate that? Well, the first thing is with your trade sizes. If you bet the farm, in other words, if you take all the money that you've got available and you put it on one trade, you've got a huge risk of upside and a huge risk of downside. Double your money within probably minutes. On the other hand, you could lose your entire stake if the thing goes in the wrong direction. So by trading small amounts, typically 1 or 2% of the total capital that you've got available, you can reduce that risk, and it means you get modest gains, modest losses. So the combination of using leverage to increase the risk and small trade sizes to reduce the risk means that you can end up with a manageable level of risk in what is a very potentially lucrative market. Now, the other thing that makes a huge difference is expertise. If you have a trader who can decide when to trade and when to stay out of the market, and if they've taken a trade, they can decide wisely when to exit it in order to capture their profit or to avoid losses getting too big, then you've got somebody working for you who's doing a great job. The problem with most beginners in the forex market is that their win rate is going to be far lower. A good trader will have a high win rate. They'll also ensure that their biggest losses are small. You can't trade a market and not make losses at all. It just doesn't happen. You will make losses, but if the losses are always small because you cut them as soon as they get to a certain small size, then you never make big losses. And if you allow your profits to run so that when you're making profit you go to a bigger and bigger profit, then you can get the balance between the two to be in your favor. If your win rate is over 50% and your win and loss sizes are balanced, then you'd be making money overall. If your win rate is really high, let's say over 70 or 80%, and you've got balanced wins and losses, then you're making a lot of money in quite a short time. And the other thing that comes into the forex market is automation. The banks and the hedge funds have all created robots, or algorithms, or computer programs, bots, call them what you like. And these scan and analyze the market. They can look through hundreds of investment opportunities and do a technical analysis of them in the blink of an eye. They can trade without emotion, so if you set them up with some rules that says when this situation happens you place a trade, and when that happens you close the trade. A robot can do this without any emotion, better than a trader can. They can set the trade sizes automatically to increase as your portfolio grows, or to reduce if you've made losses, so that you're always trading in proportion to the market. And the robots will follow the rules precisely. So if you set them up with good rules, they will do good trades. Doesn't mean that you'll win every trade, but it does mean that you get a high win rate and you get a good balance between the size of your trades that make money and the size of the trades that lose money. So let's look at these 5 ways to get wealthy. Investing every month for decades, great results if you've got the discipline, but it'll take you decades to get there. Starting your own business, likelihood is that the business will fail, even if you can keep it going. And I've done that with a number of businesses over many years. Most people will never get rich from running their own business. It's only a very small number that manage to build the business to a stage where they can sell it for a lot of money and retire, or where it's making them so much money that they can keep on with it with minimum effort, with other people doing most of the work. There's not many people that succeed in getting one of those to work. Playing the stock market, you might make money, but you're more likely to lose it. A side hustle on the internet, it could work out for you. It's going to take a lot of effort, a lot of time, a lot of frustration, a lot of resilience to make it work. Trading forex, if you do it for yourself, you're likely to lose all the money that you put in there. If you get it done for you by a competent trading outfit, you're on the route to easy wealth. If you're interested in doing this, click the button below and have a look at Easy Wealth, the People's Hedge Fund.